Building the perfect dividend growth portfolio might seem like something that only an expert dividend growth investor has the ability to do. But truly, I promise you this is not the case. You see, by building the perfect portfolio that not only offers decent cash flow from day one, which of course can be used to reinvest into more shares of more ETFs, but also along with the cash flow, a massive amount of growth potential, which means in theory you have the ability to make a massive net worth later on in life when it comes to retirements. And the craziest thing of all is that this can all be done by buying into just a few high quality dividend growth ETFs. Now in this video, we're going to go through 3 dividend growth ETFs that I would choose if I had to build as close as possible the perfect dividend growth portfolio with just 3 names. We're of course going to dig into each one of these ETFs. I'm going to show you exactly how they work and what they have to offer. Now, if you consider yourself a dividend growth investor or have an interest in becoming one, make sure to stick around, drop a like down below, and let's get into it. Now, one of my newer favorite dividend growth ETFs, this is a really good one. DGRW, the Wisdom Tree US Quality Dividend Growth Fund. This is an ETF that's been around for a while, but I just came across it within the last year, and this ETF has a ton to offer. It says Wisdom Tree US Quality Dividend Growth Fund seeks to track the investment results of dividend-paying large cap companies with growth characteristics. Looking a little bit deeper into DGRW, the expense ratio is one of the worst parts of this ETF. At 0.28%, the expense ratio is much higher than a lot of other ETFs out there. But even with that, I think this ETF still has a lot to offer to even offset the sort of negative of that. Now looking a little bit into DGRW's performance, year to date this ETF is up around 10.86%, so in the dividend growth ETF world, it's sort of in the median range. On how most of this ETF's peers have been trading, the most recent low though, 52-week range low is $58.98, and the 52-week high was $68.70. So DGRW is trading towards the higher end of the 52-week range, but I still think for a long-term dividend growth investor, there's never necessarily a bad time to buy into high quality funds like this. Now, since this ETF's inception, which was just more or less around 10 years ago, this ETF is up around 171+%. And some of the reason being on why this ETF has been growing so much is, of course, the holding breakdown. The biggest piece of the pie is technology at 31.52%. Now, if I'm going to be real here, this is my favorite part of this ETF. I love the way that the breakdown is sitting, and I absolutely love some of the top 10 holdings, which we're going to go through here in a second. But the holding breakdowns is technology at around 31%, consumer defensive at around 15%, industrials around 13%, healthcare at 13%, financials at almost 12%, and then under 10% is consumer cyclical, basic materials, small amount of real estate, energy, utilities. Now with that breakdown comes along, like I said a second ago, some super high quality top 10 holdings, things like Microsoft, Apple, Broadcom, Johnson & Johnson, Procter & Gamble, the Home Depot, Coca-Cola, Walmart, Merck, Cisco. And with this ETF having almost 300 different holdings, it's very diversified, even more diversified than some of the other popular funds out there. Now, DGRW is great in my opinion because honestly, even if you were to build a portfolio with just the top 10 holdings in DGRW, I honestly could probably sleep pretty well at night, knowing that most of these names are probably going to be around for quite some time, and knowing these names have a lot of growth potential, but also pretty much all these pay a pretty nice starting dividend yield. And speaking of DGRW, when it comes to dividend yield and dividend growth, DGRW has a 1.82% trailing 12-month dividend yield, which isn't the highest starting yield, but again, because you are going to get most likely quite a bit of growth with this ETF, I think it's honestly pretty decent. But when it comes to dividend growth year over year, over the last few years, we've seen anywhere from around 31% annual dividend payout growth, and there's even a year as of recently where the dividend actually dropped a little bit, but as of the last few years, anywhere from 10 to 12% dividend growth, which is honestly very impressive. The next ETF that I would have in my quote-unquote perfect dividend growth ETF portfolio would be the abbvie ETF DEVO. Now here on the abbvie ETF website, it says why invest into DEVO. It says income potential, comprised of high quality dividend oriented stocks, along with covered calls and individual stocks. Now because DEVO does have the covered call overlay, because this ETF is a little bit more actively managed than some others, it does have an expense ratio of 0.55%, which once again for some investors could be something to be concerned about, but with DEVO's overall performance and the potential performance, I think it's still worth it, and I currently own almost 2,000 shares of DEVO across my portfolios as of filming this video. Now DEVO is currently trading in the $35 range, so somewhere near the middle of the 52-week range. And one of the reasons I do like DEVO is that it's pretty low beta, it doesn't move around too much even during massive swings in the market, which sort of matches my investment profile. But DEVO on the max time frame is up around 40.43%, and that's not even including dividends, and DEVO does pay a nice solid starting dividend, which I'm going to show you here in a second. Now DEVO's holdings are pretty small with only 34 different holdings and things like United Health Group, some bonds, Microsoft, Visa, Apple, Procter & Gamble, JP Morgan, Goldman, McDonald's, Chevron, and others. And even though Divo doesn't have much dividend growth necessarily, Divo's dividend yield is around 5%, which is a very high starting dividend yield, especially knowing there is some growth potential along with the high dividend Divo has to offer. So for the dividend growth investors out there that want some cash flow from day one and like to get paid dividends on a monthly basis, Divo is definitely one to look into. Now, last but not least, the perfect dividend growth ETF portfolio would not be complete without having SCHD, the Schwab US Dividend Equity ETF, within the portfolio, and SCHD, as you guys probably know, is one of my, if not my ultimate favorites. Now, SCHD's objective is to track as closely as possible before fees and expenses the total return of the Dow Jones US Dividend 100 Index. Now, SCHD has the cheapest expense ratio out of all 3 dividend growth ETFs we went through. In this video at just 0.06%. Now, SCHD has had a pretty rough year, down around 5 or 6% year to date as far as price return, but on the max time frame, SCHD has not done too bad at all, up around 173% as far as just price return. And that's over the last 10 or 11 years. Now, like I mentioned, this ETF is trading pretty close to the 52-week range low, so it could be still offering a massive buying opportunity. And speaking of underperformance, the holding breakdown that SCHD has as of right now is of course the culprit on why this ETF has performed the way it has been performing. With some companies within the top 10 holdings having a pretty terrible year, companies like Broadcom, Amgen, Verizon, Coca-Cola, Pepsi, Merck, the Home Depot, abbvie, Cisco, Texas Instrument, and others. This ETF has definitely had some struggles, but I think we're going to see SCHD turn a corner real soon here. Now, my favorite part about SCHD most likely is the fact that the dividend yield is around 3.7% more or less. Now, you might be saying, well, that's not necessarily all that high of a starting dividend yield, but the real magic is here. The real magic is the dividend growth that SCHD has. So dividend growth rate is a measure that indicates the annual rate at which a company's dividend payments have increased over a specific period of time. It represents the compounded annual growth rate, or CAGR, C-A-G-R, of dividends over that period. And the dividend growth rate is often expressed as a percentage. Now, if you were to calculate the dividend growth rate, you would typically take the difference between the final dividend payment and the initial dividend payment, divide it by the initial dividend payment, and then divide that result by the number of years in the period. And finally, the result is expressed as a percentage. And to be more specific, looking at the SCHD's dividend growth historically, back since 2013, there was an 11% increase in annual dividend payout. The next year, a 15% increase in annual dividend payouts. The next year after that, 9.5%, 9.7%, 6.9%, 6.9%, then 19, 17, 10, and then as of recent last year, 13.9% of annual payout growth. Now, this is really significant to me because looking back in history, and keep in mind, just because a stock or ETF did something historically does not necessarily mean that it's going to continue to do so, but this is just basing it off of history. Back in 2014, 2013, around 10 years ago, the Schwab US Dividend Equity ETF was paying around 25 cents or so per share per quarter. Now, 10 years later, around 65, 66, or even 70 cents per share per quarter. Now, the difference in dividend payouts over the last 10 years is almost 3 times as much as you would be getting around 10 years ago. So there we have it. Those are 3 of my favorite dividend ETFs that offer growth potential, but on top of that offer cash flow from day one. But now I want to hear from you guys down below. If you were to build out a portfolio with just 3 ETFs and you had to hold on to them forever, which 3 ETFs would you hold on to? Drop their names in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.